So let us first of all get the lay of the land for where this information is coming from. And the slides that are posted to Canvas for, I believe this is chapter 14. Um, chapter 14 really dives into annuities and IRAs. We also have some chapters in the Boglehead's book that covers it. But I wanted to use these slides because it's a nice linear approach to covering these topics. In the 8 o'clock lecture, we covered all of these slides up to numero 20. Well, let's see here. We didn't really get into the taxation of individual annuities. We stopped with multi-year guaranteed annuities. But there is a question in the knowledge check on how annuities are taxed. And because it's a rude way for us to begin our discussion on annuities to go straight to taxes, why don't we just do a quick overview of annuities? I won't give you the first 20 slides. Instead, I'm going to give you a drawing. What the heck is an annuity? This slide attempts to cover both annuities and IRAs, but let's just focus for a moment on the annuity piece. So annuity is both a description of a stream of income, just a fixed sum paid to someone at regular intervals. It could be for a certain number of years, so a period certain, or over your lifetime. And it's more popular to think of an annuity as being paid over your lifetime if you're buying an annuity from an insurance company. So again, annuity is just a plain vanilla term to describe a series of payments. It's also a term to describe a thing you buy from an insurance company, right? That can be filled with expenses if you're not careful. And you buy an annuity from an insurance company for a couple of reasons. You want guarantees of some sort. Either you want to protect against living too long, right? If you're going to buy a life annuity, like, I want to transfer the risk of the stock market and of living too long to an insurance company. This is what they do. This is what they're good at. So I'm going to push my chips, or at least some of my chips, to the insurance company and see how much they'll guarantee me income for the rest of my life. But you're pooling the risk with a group of people in a pure longevity contract, in a pure life annuity. It's you and a bunch of other people, right? It's you and then all of these other people who are worried about living too long. We're like, hey, let's form a co-op. And let's just agree that if any one of us dies during this annuitization period, the leftover money goes to the rest of us to help increase our pool. So if we've got, now obviously this is not a big enough pool, but if we all throw in $1 million and we'll guarantee each other a certain amount of income for the rest of our lives, and we know that not everybody is going to make it to age 100. Some people are going to drop out. Those that live will continue to enjoy their guaranteed income, and the whole group's income will be higher during their lifetimes than it would be if you were on your own, because A, we're guaranteeing it, and B, we're going to take advantage of the fact that some people aren't going to live that long. Now, if you're not healthy, you're probably not going to buy a lifetime annuity, right? Because you're like, why would I participate in this little game if I know I'm going to be the one that's going down early? I don't want to die and give all y'all my money. Why, if I think I'm only going to live for another 10 years because maybe everybody in my family just dies early, then I'll have a happy retirement. I'll probably retire early, may as well if I'm not going to live long. And I'll just leave my heirs whatever's left instead of pushing all my chips to an insurance company. I'm not worried about excessive longevity if I'm not healthy. So typically, longevity or annuities with a lifetime guarantee are going to be purchased by people who are healthy. But you never know, right? Things happen. So in this case, the pooling of risk works really well, and insurance companies and their actuaries can help determine what is a reasonable amount of money for us to be paying these people as they show up. They don't underwrite you for health. They care about your sex and your age. So male versus female, and young versus old. Let's just break this down into 4 big buckets, right? Male, female, young, old. which one is going to get the, assuming we all show up with $1 million, a 40-year-old female versus a 40-year-old male, who's going to get a bigger annual income for your $1 million? If you show up with $1 million to an insurance company and you're 40 years old and you're a male, would you expect to get more or less than a 40-year-old female? Who's going to get more, the male or the female? Same age. And it's the female will get less because they're going to live a long time and pull more out. So we're thinking about, who do we think is going to be expensive? Who's the more expensive client, the male or the female, right? Somebody's coming to your party. Who's going to drink the most beer? Technically, in this little analogy, it's the female, because she's going to live longer, right? So when you think about annuity payments and the features that insurance companies care about, they care about how old you are and your gender. They do not underwrite you for health. There might be some rare contracts where they will be willing to consider giving you a little bit more if you're not very healthy, but you still want this thing. But usually if you're not healthy, you're not going to buy an annuity that has a lifetime guarantee feature. So when you buy an annuity, you're getting a few pieces, right? You put your premium payments into it, and you're going to get some kind of interest earnings from the time you put your money in until the time you take your money out. Now, when you put your money into an annuity, that is called the accumulation period. Where is my drawing here? And the way it's drawn here, you might think that, gosh, everybody has this long accumulation period. Not all annuities do. Sometimes you show up and you're like, here's my $1 million. I want to start my income immediately. And that's called an immediate annuity. If you show up with your money and you're like, here's $1 million, I'm going to retire in a year or two. I just want to park it somewhere safe. I'm going to buy a deferred annuity. And during this time period, my $1 million might grow. Obviously, I'm showing a much longer period here, but during that time, from the time you make your premium payment, and you could add more, if it's a flexible annuity, you could put more in over time. And then you could decide, you might flip the switch and go from accumulation to payout. So the payout phase, you flip the switch. You're like, all right, I either A, want to take the whole wad with me, which you can. You can just say, if it's a deferred annuity, you can say, I've played the game long enough. I've decided I want to go a different direction. Give me all of my money, both my premium payments and my accumulation, and you can bail and you can go do something different with the money. Or you can flip the switch and turn it into guaranteed income. And it could be guaranteed income for a certain number of years. You're like, I only need 10 years of guaranteed income. Maybe you're going to use it to bridge the gap from the time that you retire until the time that you take Social Security. So if you're like 60 when you retire, and you're not going to take Social Security till you're 70, you might say, here's my pile of money. Give me a 10-year guaranteed lifetime income. I'm sorry. Give me an income that's guaranteed for 10 years versus lifetime income, which would be a lot less, right? For the same premium payment. So during the payout phase, you could get it all in a lump sum. You could drag it out over a number of years. You could take it over your lifetime. But the payout phase is distinct from the accumulation phase. So payout phase, you decide, what am I going to do with this money? And not everybody flips to a payout phase. Some people leave their money in the accumulation phase forever, which is a pretty low rate of return, but it's usually very safe and guaranteed. So a deferred annuity is one that doesn't pay out immediately. An immediate annuity is one that pays out right away. So a lot of my favorite authors, including Jim Otar, who I've referenced on this slide somewhere. Where's Jim Otar? Here he is. So Jim Otar wrote a book called Unveiling the Retirement Myth, and he is a huge fan of using guaranteed lifetime income via annuities to cover your basic living expenses in retirement. So if you know food, shelter, clothing, insurance is going to cost you $40,000 a year, and maybe you want $20,000 a year with the travel and other fun, you would use an annuity to cover the $40,000 a year worth of guaranteed expenses that you're going to have. And you'd use the rest of your portfolio to cover the rest. So the idea is you don't put all of your money into an annuity. You might keep some of it in a portfolio, cooking at a much faster rate. Now, you might also already have, other forms of income. Maybe you've got a good Social Security check. Maybe you're 70 years old, you've got Social Security, you've got a pension. Well, then you've got 2 annuities already. You probably don't need another one, but everybody's different. You got to do the math to figure out what level of guaranteed income would this person benefit from? Because again, we are just really trying to focus on, first, people who are healthy are a good candidate, people who appreciate guarantees, and people who want to protect against living too long. They are not great for people who are not healthy, who want to beat the stock market, and who want to leave a big pile of money to their heirs. So it won't surprise you that most retirees are not big fans of annuities, because they absolutely hate the idea of dying with their big pile of money sitting inside the coffers of an insurance company instead of being given to their kids. They're like, oh, we really want to benefit our kids. But truth is, it might still benefit their kids for them to get an annuity and leave the rest of their money invested. Then those guarantees can add a lot of security to a retirement plan. All right, so we've talked about the phases, accumulation versus payout, and that not all annuities have to annuitize, and you could just walk away with your chips if you want. If you walk away too soon, if you buy this annuity and you bail within just a few years, the insurance company might put a surrender charge against them. All right, why is it advantageous to buy an annuity when you could just invest the money and take it out as needed? Couldn't you just eliminate the middleman? Yes, I mean, that seems to make sense, but what are the risks there? Let's look at an example. Let's pick on, I did some calculations, but let's start with, one moment. Where's my gal? Da, da, da. So let's go annuity shopping. First, let's use an example. I'm glad you brought that up because that sort of feeds right. It's almost like I paid you to ask that question because I needed this pivot. So let's look at the impact of, I picked a 55-year-old female, just for fun, who won the lottery. And after collecting her gross lottery, she's got $1 million worth of after-tax lottery winnings. And to your point, if we had $1 million to put in a portfolio option, the first year with this $1 million invested in a portfolio, how much could our fictitious 55-year-old female, I'm calling her Jada, how much could Jada take out of her portfolio each year? Again, she's retired. What's a safe withdrawal rate? What do we talk about? Give me a range of possible safe withdrawal rates that you might allow your client to take out of their portfolio in retirement. Nobody? Anybody? Is 10% too much? Yes. 3 to 3.5%. Yes. 3 to 4%. I think 4 is a little strong, but yeah, I would say 3 to 3.5% seems about reasonable. I mean, a lot of people will be like 3%, that's too low, and 4% is too. Let's go with 3.5%. So what if we said 3.5% safe withdrawal rate in the first year, and then after that you can take an inflationary increase. So year 1, you could take out $35,000. That's your retirement income. If you're going to go with this safe withdrawal approach to developing a retirement income plan. Year 2, if we assume that inflation is 3%, if 3% inflation, then 35,000 times 1.03. Then you could take out again, because we get inflationary increases, 36,050, etc., until this person dies. What is the risk of using this approach? What do people worry about with their retirement investments? Is it guaranteed that their portfolio is going to grow each year? What if we put this in a 30% stock? Yeah, market has a bad year, they can't take out as much. In theory, Brett, but you know what? Maybe all of her basic expenses that she has to cover are $35,000. And she's like, Brett, what do you mean I can't take out my 35 grand? Just because I had a bad year, I absolutely need to take out that money. So the risk is that you would take a withdrawal and create a permanent loss in that portfolio. If you have a series of bad years and you're taking withdrawals, especially in the early years of your portfolio, that can be detrimental. So even with a 30% stock, 70% bond mix, let's see what happened. You know, there's a portfolio out there that will give us this comparison, and it's VTINX. This is the Vanguard Target Retirement Income Fund. And the Vanguard Target Retirement Income Fund, if we look at how it's done, and oh, by the way, it's a 30% stock, 70% bond mix. Look at what happened in 2007, 2008. So 2008 at its peak, it was at whatever, 11.12 per share. And it dropped. It dropped. And it was a 30% stock portfolio. Now, all stock portfolios, ones that had 100% stocks in them, dropped by about 50%. This one dropped by closer to 25, 30%. So even though it was a conservative mix of stocks and bonds, it still experienced a decrease, and it took a while to recover. So one of the risks of retirement is that you will see volatility, and that you might still have to take withdrawals even when it's volatile, and create permanent losses in your portfolio, which means that if you need, no matter what, $35,000 and you're going to take those withdrawals, like it or not, there's a chance you're going to deplete your portfolio before you are done living. So people don't like the idea of that. So why is it advantageous to buy an annuity when you could invest the money and take it out as needed? So let's look at what the options are for this 55-year-old female. So with $1 million worth of after-tax lottery winnings, she could buy an annuity. And let's look at a couple of different options with these annuities. I ran quotes. Let's see if I can find it. Where am I? Okay, so let's just scroll to the top here. So all of these were calculated this morning for a 55-year-old female with $1 million worth of after-tax money, and various quotes were provided, including this one, which is probably the best comparison to what we just looked at, because this is saying how much these insurance companies would be willing to pay this 55-year-old female for the rest of her life only. So for as long as she lives, they will give her $2,000. Let's pick the best one. Penn Mutual Life is willing to give $2,461 a month, or 2461 times 12, or $29,532 for the rest of her life, plus a guaranteed 3% cost of living adjustment. In this quote, that's what I asked for. Most people don't pick the cost of living adjustment. They say, I'll just invest. I won't put all my money in an annuity. I'll have some set aside somewhere else that's going to grow by market returns, but not everybody has enough, right, to guarantee or to have a separate pot of money. So in this case, that 2461, let's put that here. So her life only, let's sort these out. Which one is going to pay her the most? So for her life only, level payment should give us the biggest quote. So let's put that as number one. And let's do her life only with a cost of living of 3% guaranteed will be the number two. And that one is going to give her, we said, $29,532. Per year, right? And let's look at the next one. Single life without a cost of living adjustment. Now a different company comes to the top of the pile. So this is her life only without COLA. So $43.20 per year. $43.20 per month times 12. $51,840. Holy guacamole. She's going to want that one for sure, but we got to talk her off that ledge. Because if this is all the money in the world that she has and we're worried about her living too long, well, I guess we could say, fine, take the your life only level payment, but you know, it won't be long before the cost of living adjustment at 3% per year would beat it. You got to do the math. So she might say, look, I don't need $51,840 per year. If we're going to compare it to, what did we say she was going to get with the safe withdrawal rate? She's going to get $35,000, but she's going to get COLA on top of that. With an annuity, an insurance company is going to say, look, Jada, we know you're worried about living too long, and we know you're worried about market risk. So we got a deal for you. For your life only, we'll give you a level payment of $51,840 per year. And we could probably do the math right now if I could find my time value money calculator and say, how many years will it be before this 3% cost of living adjusted annuity will reach this level, right? So if we want to know how long before $29,532 becomes this, if we're talking about a 3% adjustment, how many years will that $51,840 option beat the other option? You know what I'm saying? So if you were faced with this choice, if you were 55 years old and an insurance company says, look, you got two choices, two doors for you to walk through. One, $51,840 per year, every year for the rest of your life. Or, and that was level, never going up, or 3% per year adjusted payments compound of $29,532 per year. Which one would you pick? What would determine which one would look more appealing to you? And while you're thinking of that, did you guys have trouble getting in to this session? I'm hammered with emails saying people can't get in. Now, I have a feeling you had to log in, right? You had to log in through your UW. Well, you guys all passed the test apparently, because I have a few people that couldn't, but apologies that I didn't make it clear that you had to log in with your UW account in order to get into today's session. That's why I'm recording it. All right, so let's go back to this problem. So if we do time value of money calculation on how long will it take for this payment to become $51,840 per year, that should be pretty straightforward. I'll give you a minute. Let's see if we come up with the same answer. Be sure to use opposite signs for your present value and future value, and 0 for the payment, right? What'd you get? Anybody? Anybody do it? Brett, what variables did you enter? What did you put in for present value? Present value should be this. So I have a feeling if you switch it to a present value of, because we're evaluating the difference between taking these two payments, we're just trying to get a sense of how many years worth of delight are we going to have before suddenly we're going to like, oh man, now the other one's beating it. So this one eventually is going to catch up to this one. The question is, how long will it take? So if we use a present value of 29, a negative 29,532, a future value of 51,840, 0 for the payment, 3% for the annual rate, and solve for periods, what do you get? Nobody? Come on. Yes, yes, yes. Yes, Ruby, that is exactly what I get. So it's going to be 19 years where this payment is going to win. And so if we're a 55-year-old female, we make it to 74, right? Where this felt like the winning option. And maybe, I don't know, I guess you could invest the difference if you wanted to and help make up the gap. But the benefit of the Your Life Only with a 3% guarantee is that, once you hit 75, you're going to get at least this much plus inflation. So getting those guarantees can be really delightful to people, but there's a cost to this, right? The cost is when you die, your heirs aren't going to get anything unless you choose to add some kind of an option on there for a survivor benefit, which will drive down the amount that the insurance company is willing to give you. So, all right, what else did I want to cover? So that, and that's the conundrum, right? So Blake, going back to your question, the advantage to buying an annuity is the guaranteed nature of it. You're outsourcing market risk, you're outsourcing longevity risk. Because if most people do retirement calculations assuming they're going to live to age 90, but some people live to 100 and beyond, which could get super expensive, especially with inflation and market fluctuations and dumb things that we do with our money. Having your money in an annuity prevents you from rating that principal, right? Because going back up to Jada and her big pile of like liquid assets that she could use, this $1 million is just sitting in a brokerage account. And I can't tell you the number of times I have people come in, you ever see those commercials that, I don't remember who, I think it's Fidelity, and it's like, change a plan. Yeah, change a plan. Like, I don't know what these people are doing, but they're always changing their plans, which is great if you're like completely and totally wealthy. But if you're going to change your plans to cover something huge and expensive in retirement that wasn't planned on, and you're going to raid your portfolio to do it, people sometimes lose their minds in retirement. And they're like, oh, I'm so rich. I've got so much money. It's like, we're going to need that money, people. Let's be thoughtful about how we're spending it. So anyhow, having that liquidity can lead people to make decisions like buying RVs that are really expensive and depreciate the minute you drive them off the lot. Not that you can't buy an RV, but let's just factor it into your plan to begin with. And if it wasn't in the plan and you buy an annuity instead, once you buy the annuity, you can't, that liquidity isn't there for you to like change your mind and go buy the RV. So pros and cons. Any other questions about annuities so far. We talked about the fact that a single premium immediate annuity is one that you walk into the insurance company's office and you're like, here's a bunch of money, give me guaranteed income for life, like we just did for Jada. You could also buy other forms of annuities, ones that cook for a while, and then you can take your money out, either flip it to payments or just take the lump sum out. These longevity annuities you buy today with a payment to begin usually in your 80s. And this is a big bet against living too long, and it can be a much lower premium payment to generate that lifetime income that begins at in your older years. We talked a little bit more about that in the earlier lecture. So a joint annuity is over 2 lives. So let's say Jada wants to like cover both her life and her spouse's life, then you can get the quote from the insurance company over 2 lives and just say, for as long as either of you is alive, you will get ongoing income. But the moment the second person passes, it's game over. And when you're insuring 2 people, the payments usually go down. And then actually, I apologize. So that joint annuity, this one, technically that definition is until the first death. The joint and survivor annuity is till the second death. Very unusual that you would see this. Typically, you're seeing a joint and survivor annuity payment when there's 2 people involved, because you want the coverage to last. You want that income to last as long as they do. Deferred annuity payout options. Again, if you want to park your money somewhere very safe for a period of time and then take your money out, you can take a lump sum, or you can flip the switch and turn it into guaranteed income for life. Or for another period, you could do it for your life only. You could do it for your life with a certain number of years guaranteed. You could do it for your life and have your heirs receive a refund if you never got back the amount that you originally put in. So if you put in $1 million into this annuity and you started getting payments off of it, but you never even got to the original $1 million you put in, the insurance company will be like, fine, we'll give the balance to your heirs if you really want us to, but it'll reduce the amount of income that you'll get. And as I just showed you, you can get a cost of living adjustment added to your annuity payment, but it drives down the first year amount that you would get. Or you might just pick a period certain if you want to fill a certain number of years with income, like I need 10 years worth of income guaranteed. How much is it going to cost me? So annuities are pretty flexible. They're very confusing, and the best ones aren't sold, they're bought, and you got to hunt for them, which is why I really like this website, immediateannuities.com. Filled with lots of really helpful information that explains the difference between these annuities, and it shows you what how competitive these rates are and who the companies are that are offering them. Many times you've never even heard of them. You're like, who are these people? The ones that don't have great financial strength ratings, although all of these people for the single life annuity have financial strength ratings of A or better, we could probably find some that aren't so great. But the state guarantee fund, if any of these companies goes belly up. So like if you pick Penn Mutual, you're like, man, I love Penn Mutual, they're going to give me the most money. If they end up going belly up and they're like, we're sorry, we can't afford to pay you anymore. You're like, what? This is guaranteed. Well, it still is, because the state of Wisconsin, just like every other state, has a guarantee fund that backs companies that go belly up. In Wisconsin, the guarantee fund will back up to $300,000 worth of contract purchase. So going back to Jada and her $1 million worth of annuity income, I would never buy $1 million contract from any one company. I would always spread it out. So I'd look to buy it from probably 4 companies. I'd do $250,000 per company and tolerate a lower amount of income, because in this case, we would spread it across these top 4, most likely, although there's not much difference between AIG and United of Omaha. But that way, if any one of them goes belly up, the state of Wisconsin guarantee fund will step in and make the person whole. it would be scary and a pain in the butt, but it is guaranteed. It's not FDIC insurance, but it is an option for people to consider when they're worried about guarantees. The other thing to note is if you go and work for any insurance company and you're going to sell annuities, you are not allowed to bring up the fact that there's a state guarantee fund to back them, because the state guarantee fund doesn't want your sorry behind with your low AM Best rating to start peddling your products saying, don't worry that we're not such a great financial strength rating because you're guaranteed anyways. Not allowed. Complete and total no-no. The reason why it's a no-no is because all of these financially strong companies and even the weak ones have to pay into the state guarantee fund to participate in the insurance market. And so it's other companies that are like, look, yo, you're not allowed to even talk about this guarantee fund because you got to stand on your own when you make the sale. And so it's not very well understood by clients that there is a state guarantee fund. Questions on that? All right. Let's talk about, let's pivot. Let's go to IRAs, shall we? Oh, an easy topic, right? Wrong. IRAs are complex. We'll try to start at a high level though. So as you know, there's two main flavors of individual retirement accounts. There's traditional and there's Roth. But even within the traditional, there's deductible traditional and non-deductible traditional. And then the Roth is always Roth. And then of course you can always convert. You can do a conversion from traditional to Roth, but you got to pay taxes on the way out. It's called a Roth conversion. And for a Roth, there's the front door into a Roth with your earned income, or you can do a backdoor Roth where you make a non-traditional, where you make a non-deductible contribution to a traditional IRA and then immediately convert it. So many complications, and right now it's all up for grabs because it's being debated with the changes that are being considered in taxes for this coming year, and that backdoor Roth is possibly on the chopping block. We shall see. So traditional IRA, this is the original IRA. It is the one that lets you take a tax break for all or part of your contribution. The point might be moot. If you work for a company that has a 401k with a big limit that you're not taking advantage of, you maybe don't even need a traditional IRA account. You're like, why do I need this thing? And you don't if you've got all of your retirement savings needs are being met by your 401k, you could ignore the individual IRA, I suppose. But in order to make contributions to it, you have to have taxable income. Once you make the contribution, you've got to decide whether or not you can deduct it. And that depends on whether or not you've got a company sponsored plan. It also depends on what your income level is. Once you take the money out, you will be taxed on that like ordinary income, which is sad. So you're really making a bet. If you make a deductible contribution to a traditional IRA today, you're saying, I think my taxes today are worse than they're going to be in the future. Or I want the break today, and then I want the tax deferred earnings, and then I'll worry about whatever happens when I go to take the money out. So a lot of people think that it's sort of a difficult decision, which is why I'll show you a process that you can follow to decide whether or not you want to go traditional or Roth. You eventually have to take out distributions. You must take distributions eventually from a traditional IRA once you hit age 72 and a half. There's a maximum. This slide gives you the 2018 maximum. In 2021, I never trust my memory. Let's see, what is the most that you can contribute to an IRA? $6,000. So it grew. Plus, if you are over age 50, you can put in another $1,000 per year. Over 50 catch up. Yay. So if you're over 50, you can put in $7,000. And that's either into a traditional deductible, traditional non-deductible, or a Roth IRA. So the full deduction, it's like, okay, maybe you've got random part-time jobs. You don't have any access to a 401k. You're like, man, I want to reduce my taxable income for this year. Am I going to be able to take a deduction? And a full deduction you get in two situations. One, you're not an active participant in an employer plan, and you can take the full deduction. Fully deductible up to the annual contribution limit, which if you're under 50 right now is $6,000. But let's say you are participating in an employer's retirement plan. If your income is below a certain level, then you could potentially deduct the contribution. The truth is the income levels are so low that the odds that you're going to do both, participate in an employer plan and make a contribution to an IRA, and be under that income limit is pretty unusual. So taxpayers with incomes that exceed the phase out limits can make a non-deductible IRA contribution. This is a very popular maneuver with people who are in high income tax brackets because they're like, oh my gosh, I make all of this money and I'm taxed at horrible rates. And I really want to find a way to save in a tax deferred way. They could put some money into a non-deductible IRA. And when we say IRA, it's not like there's only a certain place where you can go buy IRAs. IRAs are a wrapper that you put around an account that indicates how it's going to be treated for tax purposes. You could go to a bank, which I wouldn't do, but you could go to a bank and open an IRA. You could open an IRA CD. I run into these all the time. I'm like, why did you do this? You could go to Vanguard and open up an IRA, either a traditional or a Roth. You could go probably Robinhood. You can open up an IRA, which I wouldn't do, but anyways. And I wouldn't do it only because usually with Robinhood, you're trying to, well, I shouldn't speak to that. Maybe you should do it there, but anywhere that you're saving for retirement, I'm happy, but I wouldn't get too aggressive with your retirement savings in terms of day trading. I digress. So distributions that you want to take from IRAs, though, this is the downside. So if you're somebody that wants to retire early, and by early, I mean before 59 and a half, you're going to probably need more pots of money than just IRA money. Because if you're going to take your money out before 59 and a half, it's considered an early withdrawal. And there's only a certain number of situations where you can get at the money and not pay this 10% penalty tax. You want to remember that 10% penalty tax doesn't seem like such a big deal, but my God, it's quite a chunk of change. So this applies unless you meet a certain, there are certain reasons why they'll let you take the money out with and not be subject to that 10% penalty. And one of them is death and another is disability. But regardless of when you take the money out from a traditional IRA, the entire withdrawal, if it was a deductible IRA, is going to be considered taxable income. If you made any non-deductible contributions, those are income tax free because you already paid tax on that. Including this whole non-deductible traditional IRA part in this discussion adds a layer of complexity that you might have your mind blown by if you haven't already studied IRAs. And so don't be concerned if you're like, well, this is like blowing my mind that there is such a thing as a non-deductible contribution. It'll gel, I promise. So as I mentioned, you can open these things anywhere, a bank, a mutual fund company, a brokerage, even you can go to an insurance company. And a lot of insurance companies want you to open up, buy an annuity IRA, which I think is maybe the least appropriate place for you to park your IRA money because you're already getting tax deferral within an IRA. You don't need to buy, an annuity gives you tax deferral too without it being an IRA. So, and it pays a lower rate. So it's just sort of this double tax deferred nature that doesn't get you any benefit. So I would think long and hard before I would use an annuity for my IRA savings. Maybe after you're done working and you want to convert your big pile of IRA money that you have at Vanguard or wherever you built it up, and then you want to buy an annuity with it, fine, do that. But don't start young with a deferred annuity. I think that would be silly. All right. This IRA rollover concept you run into a lot when you're a financial planner. Oh my God. So you have people that have their money, it's sitting inside of, various IRAs. You'll have an Edward Jones IRA, they'll also maybe have some IRA at Schwab. Because you can have multiple, right? You can't max out the 6,000 in each of those. You get $6,000 a year that you could put in, but if you wanted to, I guess you could put 3,000 into your Edward Jones traditional and 3,000 into your Schwab. And keep in mind that 6,000 per year is aggregated across all IRAs, not only per custodian, but like all IRA types. So if you have both a traditional and a Roth IRA, you can contribute to both, but your maximum annual contribution to all IRAs combined can only be $6,000. Okay. But let's say you run into a client, they're like, they've got all of these assets all over. Maybe they've got a 401k and they'll have a 403b and it's all pre-tax money. And you're like, man, I really think you should have one IRA at Vanguard. I love Vanguard, I do. So I'm going to use them. So let's say Vanguard. And you could roll all of these into a new IRA at Vanguard, and that's considered a rollover. And the important thing to remember with a rollover is you should go directly from each of these individual companies to this new custodian. What does that mean? I don't want the check made payable to you. It needs to be made payable to Vanguard on your behalf. If it goes directly to you, the first one is a freebie as long as you get that money from you to Vanguard in 60 days. The problem, people used to, because the 60-day thing, they're like, I got 60 days to mess around with my money and then I got to get it quick to my new IRA. And so they go to Vegas or they bet on it with some investment. The IRS is like, no more of that. You get one per year. So if you decide that you're going to take your Edward Jones IRA, make it payable to you, and then the clock starts ticking and you got the 60 days to get it to Vanguard, you get that one, right? But if in that same year you try to do the same maneuver and go to Vegas and put it all on a roulette bet, and you try to do the same thing with Schwab and your 401k and your 403b, they're going to treat all of those as if they were taxable withdrawals. So don't take the money in your name. Do a custodian to custodian direct transfer from these companies directly to Vanguard. Don't ever take the money in your name. And that will eliminate that potential problem. That's a fairly recent addition to the rules. So it can be important to remember when you're giving advice. When you're helping people do rollovers, go direct from the company to the new one. All right, so then we have the beloved Roth. The benefit of the Roth, tax-free withdrawals, tax-free growth. The downside of the Roth is you don't get a break today. So maybe today you don't care. You're like, even if you're in a bad tax bracket, you're like, I don't need the tax break today. In the future, things are going to be so much gloomier. I'm just convinced of it. So I'm going to not take the break today. I'll go Roth. And that's fine, right? You can do that. But it does accumulate tax-free. So you're not getting a 1099 each year, just like with a traditional IRA. And the withdrawals come out tax-free, and you're never forced to take distributions. The one caveat to that is if you inherit a Roth IRA from somebody other than your spouse, the IRS is like, we want you to take distributions. They won't be taxable, but we want you to take the money out because we don't want you to have this giant Roth IRA. And Roth IRAs, it says they have generous income limits, but you are definitely limited to, like, let's see here. If you are single and make more than $140,000 a year, you cannot do a Roth IRA contribution directly. Sorry. If you make less, there's a phase out of between $125,000 and $140,000 worth of earnings. So if you make less than 125, you can go all in on a Roth IRA without having to create any clever maneuvers. So from 125 to 140 is the phase out. It reduces until you get to 140 or more as a single person. You cannot go straight into a Roth IRA. But what you could do is a backdoor Roth and make a non-deductible contribution to a traditional IRA. And then the next day, roll it over into a Roth IRA, because you can do that. It's called a Roth conversion. And since you didn't make any money on that non-deductible traditional IRA contribution, it's a tax-free exchange. You go from non-deductible traditional to Roth, and poof, it's like magic. It's so dumb. I mean, it really opens the door for everybody to have a Roth. Why do we make people go through this backdoor craziness? It's such a small amount of money. It's so dumb. So that's why, who knows what will happen with the tax changes. But if you or your clients are in a position where they can't do a direct Roth IRA contribution because they make too much money, they can always do a backdoor Roth. So in order to do a Roth contribution to begin with, like to go straight into a Roth, you need earned income, right? To do a Roth conversion from a traditional IRA to a Roth IRA, you just need to have traditional money in that traditional account. If you have let's say here you are, you're in your 20s or whatever age you are, and you've been making contributions to traditional IRAs because you weren't sure what the hell you were doing. So now you're just like, oh man, I'm in my 20s. I'm smarter now. I have this IRA balance. It was all done with pre-tax money. So let's say you've got $10,000 sitting in a traditional IRA. Oh, come on now, traditional. Filled with pre-tax money. So you took a tax deduction. And let's say you've got $10,000 in it. And you want to send it into a Roth. You're like, I've heard about the Roth. I just want to convert this thing. You can. You can convert it to a Roth. But in the year of the conversion, you will pay income tax on this entire $10,000 as if you earned it, which can be painful or it can be not so painful. Because what if you convert it in a year where you make no money? So let's say 2022, you're planning to be a student the whole year and make nothing or make very little money. And you're like, hey, my tax bracket is going to be nearly zero because I'm going to ghost out all of my income with a standard deduction. Well, that's fantastic, because then you'll be in a super low tax bracket of zero if you make no money, other than this $10,000 conversion, and you'll end up converting it to a Roth without having any erosion. So the after tax, I should probably write that out. So you might be able to get the whole 10,000 into that Roth without paying any tax on it if you're in a low enough tax bracket. But let's imagine you're in the 10% bracket for the feds, and let's say you're a Florida resident, you don't have any income tax because I'm lazy and I don't want to do the math for Wisconsin. If you were in the 10% marginal tax bracket, you can convert that $10,000 to a Roth. We give up 10% of it to income tax, but you're like, I don't care. I would just want to get the money into the Roth, right? So we'll pay her 10,000 or 10%, get 9,000 into the Roth and watch it grow and never pay taxes on it again. You're like, fine, I'll do that now, right? There is no penalty for doing that. So remember how that early withdrawal penalty of 10%, that doesn't apply when you're doing a conversion, because you're just going from one IRA to another. It only applies when you take the money out for you to spend. Questions on that? Usually it creates tons of questions. So let's do this. Let's look at it this way. What time is it? 10:28. Time flies for me. I don't know about you. All right. So let's do blah, blah, blah. Where is my drawing? Here we go. So this little drawing is intended to illustrate in a very simple way the tax treatment of both money coming in and out of these various account types. I've added a third, one of my favorites, the health savings account. As you recall, a health savings account gets used with a high deductible healthcare plan. And if you have a high deductible healthcare plan, love those, you can make contributions to a health savings account. And there's no requirement that you use the money each year. This differs from a flexible savings account that you use with a traditional healthcare plan. So a health savings account is maybe the best type of account of all, which is why it's in here. So let's just do a quick review on these account types. So we're looking at the traditional IRA, we're looking at a Roth IRA, and we're looking at an HSA. We're considering how the contributions are treated when they go in, and then we'll look at how are the distributions treated when they come out. So for this traditional IRA, we're looking at a traditional deductible IRA. And when you make a contribution to a traditional deductible IRA, that implies that the contribution is tax deductible. It reduces your taxable income dollar for dollar. Right now, we know that the maximum you can contribute in any 1 year, if you're under 50, is $6,000. That changes every few years. But when you go to take the money out, it is taxable to you as ordinary income. Which can be painful if you think tax rates are going to go up significantly by the time you retire. It's also going to be subject to required minimum distributions at age 72, meaning at 72, you got to take the money out. And a 10% penalty for early withdrawal. Oops. So ordinary income on the way out, RMDs, 10% penalty for early withdrawal. But man, if you're in a bad tax bracket, you're like, I love that tax deduction, right? So if you make a contribution, let's say you are in the worst tax bracket of all, which right now is 37%. So if you put $10,000, that wouldn't work. Let's do $6,000. Let's do $6,000 into a traditional IRA at the worst tax bracket of 37%. You are obviously saving 37% of $10,000. So $3,700 in tax savings. Oh my God, that's delightful. People are like, I love that. Of course you do. We all love it, especially when you're in a bad tax bracket. But here's the problem, that 37% tax bracket, well, that's the worst one now for the federal marginal brackets. When you retire, what happens if the tax brackets go even higher? Meaning, what if we will owe even more income tax than that? Well, who knows? Who knows? Maybe you'll think you'll do something clever, like you'll retire early and you'll look poor for a few years and you'll maybe do Roth conversions or something. So then let's go down to the Roth. So with a Roth IRA, your contribution goes in after tax. So that same $10,000 contribution, if you're in the 37% bracket, saves you nothing, right? Oh, I changed it from 10 to 6. Sorry. So 6,000 times 37% is a savings of $2,200 on $6,000 if the 37% bracket, right? Versus in a Roth, that same $6,000, zero tax savings up front. Boo-hoo. I want my tax break. But look, you're gonna enjoy, as you do with all three of these, tax deferred growth, right? So that's the one thing they all have in common: tax deferred growth, tax deferred growth, tax deferred growth. It's the difference is what happens to your tax bill when you make the contribution and what happens to your tax bill when you take it out. So it involves a lot of estimating on where your taxes are going to be now and in the future. So with the Roth, people love it because it acts as a hedge against tax increases, because your withdrawals are always tax-free. Always. Zero income tax, as long as you wait till 59 and a half to get at the gains. Zero income tax, and you can always, there's so few times that we get to use the word always access your contributions anytime without penalty, because you made them with after-tax dollars. So when you put money into a Roth, let's say you put your $6,000 in, and you've got, maybe after a while, you've got $1,000 worth of gains. You only make one contribution, and you're like, oh man, I made that Roth contribution 4 years ago. I put 6,000 in, now it's got $1,000 worth of gains. I really need that money. You could, if you needed to. I would hate it. I would cry a little bit, but you could access that $6,000. You could take the 6,000 out and you would owe no tax and no penalties, even if it happens while you're in your 20s. Now that $1,000 worth of gain though, you better leave alone, because if you touch the gain, boom, taxes, boom, penalties. So you owe income tax and you owe penalties, because the IRS is like, we told you this is for retirement. If you're going to turn this into just some sort of crazy investment account, no, we don't like that. But you can always get at your contributions because you already paid taxes on those. So people love the Roth for that reason. I hate that they love it for that reason, because I really don't want you to take the money out until retirement, because that's Roth money is precious money. It is what everybody wants to have at retirement. So I say borrow instead of taking money out of your Roth if you can avoid it. I mean, everybody's situation is different. But. All right. And then the last, most precious of all is the HSA, because it's the only one that is tax deductible going in, tax-free coming out, and tax deferred on the ride. Now, the one caveat is it's tax-free for qualified withdrawals. And you can get at it before 59 and a half. There's no rule about that, because the health savings account was created for you to use it during your lifetime. It's just that as an advisor, you're going to tell people, please don't touch it. I want you to let it ride for as long as possible. All right. So if the max contribution is $6,000 and you contribute that amount to a Roth while being in the 37% bracket, is the effective maximum amount you can contribute $37.80 a year? No, you can still contribute the $6,000 per year, but when you consider what it costs you to make that contribution, like to your bottom line, it might be easier to think of it in terms of like if it was a 401k versus like a traditional versus a Roth 401k. So let's say you make some insane amount of money. Let's say you make $500,000 per year and you're self-employed. And if this is the case, you should just open up your own 401k, but let's just pretend you hit it big on Etsy one year. You're like, oh my God, all my bags just went, because I actually had that happen to a client. They're adorable people. Never made much money, but the wife created some, I don't even know what she was making, but she was selling it on Etsy, and she had one glorious year of income and it was big. And she was just like, they ended up investing it in rental properties. I digress. If you have one glorious year where you're making $500,000 a year, even with your standard deduction or itemized deductions, you're still going to be in the worst possible tax bracket. Let's say you're in the 37% bracket, right? And if your taxable income is $500,000 per year before you make your contribution to an IRA, if you go traditional, and since you don't have an employer plan, there's no income limit. So traditional versus Roth. If you don't make any contribution at all, you're going to owe on the last $6,000 of that $500,000 worth of income. That $6,000 is going to be taxed at 37%, because the tax brackets are progressive. So if you make a $6,000 contribution to a traditional IRA versus a $6,000 contribution to a Roth IRA, what do you have left over? Let's say we're going to ignore the tax bill in between, but the traditional IRA will have saved you 30%, 37% of the $6,000 in tax, or $2,200. in the year of the contribution. With the Roth, how much did it save you? In the year of the contribution, the Roth saves you how much in tax? Come on, you know this. Correct, Olivia. It's nothing. So 0 tax saved. So when you're working with a family who's like, I need every dollar I can get because my expenses are so big and I just want to save, I'll save, but I really, I don't have much room to make these contributions. Well, it technically only cost $6,000 minus $2,200 or $2,220. So the net cost in cash flow for the traditional deductible was $3,780, which is your point. So yes, so you still make that $6,000 traditional IRA contribution, but it really only felt like it cost you $3,780. Is that what you're getting at, Thomas? I mean, you still are making that $6,000 contribution, but outside of that IRA, you experienced a tax savings. So, that's delightful, which is why people go with the traditional over the Roth. I'll share with you these flow charts that help you identify, can you make a deductible IRA contribution and whether or not you should go Roth versus traditional. I'll upload those to Canvas, but I think it's too much to go over them right now because usually by this point, after an hour in on a Zoom meeting, I think we're all done.